Two portfolios, same $10,000, same three Fidelity Index Funds, same day, same account, same market. One of them grows into a monthly income stream of roughly $2,000, the other about $98 a month. That's not a typo. The portfolio paying 21 times more income uses the exact same funds as the one barely paying anything. The only difference? How much went into each fund. Most people spend all their time picking the right funds. They compare expense ratios, they check top holdings, they read every rating, and that stuff matters, but it's not the decision that changes the outcome. The decision that changes everything is the weight. How much of your money goes into each fund? Get the weights wrong, and the best funds in the world won't save your income. By the end of this video, you'll know exactly which three Fidelity Index Funds handle every job a retirement portfolio needs. You'll see both versions of this portfolio side by side, and you'll understand why one setup pays $2,000 a month for life, while the other barely covers a phone bill. And the part that surprises most people, the fund everyone skips, is actually the one doing the heaviest lifting. Quick note, I'm not a financial advisor or government employee. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. So, what are the three funds, and which one is the one most people underestimate? Let's start there. The three funds that handle every job. Every retirement portfolio needs three jobs done: income now, growth for later, and a safety net that doesn't depend entirely on America. These three Fidelity funds handle those jobs better than anything else on the platform. Fund number one is FDVV, the Fidelity High Dividend ETF. This is the income engine. It holds about 110 large and mid-cap U.S. companies that pay high dividends. The expense ratio is just 0.15%. The current yield is around 2.9%. And the top holdings might surprise you. NVIDIA is the biggest position at 7.6%, then Apple, then Microsoft. That doesn't sound like a dividend fund, does it? Here's why those names are there. These companies got so big that even a small percentage of their profits creates massive payouts. Apple alone paid over $15 billion in dividends last year. FDVV isn't chasing yield from slow companies. It's holding the most profitable businesses in the world, businesses that are now paying real income. Quick note, a dividend is a piece of a company's profits paid back to shareholders. The more shares you own, the bigger the check, usually every 3 months. Fund number two is FNCMX, the Fidelity Nasdaq Composite Index Fund. This is the growth engine. It tracks about 3,000 companies on the Nasdaq exchange. The expense ratio is 0.29%. The yield is tiny, just 0.48%, but the 5-year annualized return is over 14%. That's the highest of all three. The Nasdaq isn't a fund or a company. It's a stock exchange. Most big tech companies list their stock there, so a fund that tracks it ends up heavily weighted toward technology. About 58% of FNCMX sits in just 10 stocks. That's concentrated, but it's concentrated in the companies driving the global economy. Fund number three is FTIHX, the Fidelity Total International Index Fund. This is the global safety net. It holds over 5,000 stocks across developed and emerging markets, basically the entire world outside America. The expense ratio is the lowest of all three, at just 0.06%. Now, most people skip this one. International stocks have underperformed U.S. stocks for over a decade, so why bother? Here's the myth. International funds always lose to U.S. funds. Here's the truth. From 2000 to 2009, $1,000 in international stocks grew to nearly $2,000. That same $1,000 in U.S. stocks, it dropped to $764. The decade matters. And right now, international stocks are trading at one of the biggest discounts to U.S. stocks since the dot-com era. But here's what really makes FTIHX special. It has the fastest growing dividend of all three. Nobody talks about it, but that dividend growth rate is going to do something remarkable inside the income portfolio. You'll see exactly what I mean in a moment.
So now you know the three funds, but here's where the real experiment starts, because these same three funds can be built two completely different ways, And the difference in monthly income is hard to believe. Let me show you. The dividend machine, built to pay you. Meet Gloria and Ray from Pennsylvania, both 58. They put $10,000 into these three funds with one goal: build the biggest possible income stream by the time they're ready to retire. Their split looks like this. 50% goes into FTIHX, the international fund. 30% goes into FDVV, the dividend fund, and 20% goes into FNCMX, the growth fund. Wait, 50% in the international fund for an income portfolio? Here's why. FTIHX has the fastest growing dividend of the three. Over time, that growth rate is the engine that compounds income the hardest. FDVV at 30% provides the immediate yield, cash hitting the account right now. And FNCMX at 20% keeps a growth anchor so the account doesn't stall. Even with 50% in international, the US side still adds up to 50%. FDVV plus FNCMX. So this isn't abandoning America, it's splitting the portfolio evenly while letting the international fund do the heavy dividend lifting. On day one, this portfolio yields about 2.2%. That's $223 a year on $10,000, about $19 a month. Not exactly life-changing. But Gloria and Ray do one thing that changes everything. They turn on dividend reinvestment, called DRIP. Every dividend gets used to buy more shares. Those new shares pay their own dividends. Those dividends buy more shares, and the cycle keeps going. Here's how powerful that is. Hartford Funds published research showing that since 1960, 85% of the total return of the S&P 500 came from reinvested dividends, not price gains, dividends being put back to work. So here's what happens to Gloria and Ray's $10,000. After year 10, the portfolio has grown to roughly $28,600. Monthly income has climbed to about $79. After year 20, it reaches roughly $81,800. Monthly income is now around $460. And by year 30, the portfolio has grown to roughly $234,000. The monthly income? Around $2,000. That's $2,000 a month from a $10,000 investment. And here's the part that matters most. Gloria and Ray don't sell a single share to get that money. The dividends just show up. The account stays whole. The shares keep compounding. That distinction matters, and you'll see exactly why in a minute. So that's the version built to pay, but there's another version of this portfolio. Same three funds, same $10,000. It grows into something much bigger. The account is larger, way larger, but the monthly check, that's where it gets interesting. The growth engine, built to grow the account. Now the weights flip almost completely. 70% goes into FNCMX, the growth fund, 20% stays in FDVV, and just 10% goes into FTIHX. FNCMX's 14+% annualized return does the heavy lifting here. This portfolio isn't built to pay anyone, it's built to grow the account as fast as possible. After year 10, the portfolio reaches roughly $35,200. After year 20, about $124,000. And by year 30, it's grown to roughly $437,000. The account is nearly twice the size of the dividend portfolio, but the blended yield is only about 1.2%. And FNCMX doesn't grow its dividends very fast, so by year 30, the monthly income from this portfolio is roughly $98. Let me say that again. The portfolio worth $437,000 pays $98 a month. The portfolio worth $234,000 pays over $2,000. Same funds, same starting amount. The only thing that changed was the weights. Before I show you why this gap matters even more than the numbers suggest, drop a comment right now. Are you building your Fidelity portfolio for income, for growth, or are you still trying to figure out the balance? I read every single comment. Now, some of you are doing the math. You're thinking $437,000 times 4% is about $17,500 a year. That's roughly $1,458 a month. So isn't the growth portfolio still the better income play? Fair question, but there's a problem with that plan, and it's the one that actually puts retirement accounts in danger.
The risk nobody sees coming. The 4% rule says you can pull about 4% of your portfolio out each year in retirement without running out of money. Bill Bengen created that rule in 1994. He recently updated it to 4.7% in his 2025 book. But Morningstar's latest research suggests something lower, closer to 3.9%. Here's the problem nobody talks about. That rule requires selling shares. Every month, you sell a piece of your portfolio to pay yourself. And if the market drops 30% or 40% in the first few years of your retirement, you're selling shares at a loss just to cover expenses. That's called sequence of returns risk, and it's the single biggest reason retirees with large accounts can still run out of money. A retiree who started withdrawing 4% from $1 million portfolio in the year 2000, right before the dot-com crash, ended that decade with less than $500,000. Same market, same decade, but the losses happened first. Now look at Gloria and Ray's dividend portfolio. Their $2,000 a month comes from dividends being paid out. They don't sell anything. Their shares stay invested. When the market dropped in 2020 and again in 2022, FDVV paid every single quarterly distribution without interruption. The funds you pick open the door. The weights you choose decide what's behind it. Neither portfolio is wrong. They're two different bets on what you want your money to do. But if you want income you can count on without worrying about what the market did last Tuesday, the dividend tilt gives you that. The growth tilt gives you a bigger number on a screen. So now you know the three funds, you know the weights, and you know why the dividend tilt pays 21 times more. But there's one more thing most people miss, the setup step on Fidelity that actually makes all of this work. The setup that makes it work. Three things most investors skip on Fidelity, and skipping any one of them stalls the entire strategy. First, where you hold each fund matters. Hold FTIHX in a regular taxable brokerage account. That lets you claim something called the foreign tax credit on your taxes. Foreign governments withhold a piece of international dividends. In a taxable account, the IRS lets you get that money back. In an IRA, you lose it. Hold FDVV in a Roth IRA if you can. That growing dividend stream becomes tax-free forever. And FNCMX goes wherever you have room. Roth for growth, traditional IRA, either works. Second, turn on DRIP for FDVV yourself. Fidelity's default for ETFs is to deposit dividends as cash. It sits there doing nothing. You have to go into Account Features, then Dividends and Capital Gains, and change it to Reinvest in Security. That one toggle is worth thousands of dollars over 20 years. Third, rebalance once a year. If any fund drifts more than 5% from its target weight, sell the overweight and buy the underweight. No commissions on Fidelity for any of these trades. One more thing for anyone collecting Social Security. Dividend income counts toward your provisional income. If that number crosses $25,000 for a single filer or $32,000 for a married couple, up to 85% of your Social Security becomes taxable. That's called the tax torpedo. Putting FDVV in a Roth sidesteps it entirely. Roth withdrawals and Roth-generated dividends don't count toward that threshold. If someone you know is building a Fidelity portfolio for retirement, send them this video right now. That one drip toggle alone could change thousands of dollars in their outcome. Drop a comment. Which of the three funds surprised you the most? Was it FTIHX being the dividend growth leader? I want to hear it. If you're building retirement income and want to stay ahead of the strategies that actually protect it, subscribe to Dividend Hustle. I cover everything that keeps your income growing. And if you want to see what it takes to turn these same Fidelity funds into $1 million portfolio, I ran those numbers across 10, 20, and 30-year timelines. That video is on screen right now.